With our property market surging, people are starting to ask, is this more than a property boom? Are we about to enter a property bubble? And that's what I'm going to discuss today with property researcher John Lindeman. We're going to explain the difference between a boom and a bubble and what we think's ahead for our property markets, so you're going to have some more clarity in making your investment decisions. But before I have that chat with John, I'm going to explain to you what it takes to be in the top 1% of wealthy Australians. In fact, we're going to talk about what it takes to be in the top 1% of wealthy people in the world. And the figures I'm going to share with you, they may surprise you. In fact, if you're listening to this, you're likely to be amongst the top 1% of wealthy people in the world. Don't believe me? Well, wait in a second and I'll explain it to you. And then I'm also going to share with you what you can do to work your way further up the ranks. And I'll have my regular mindset message for you. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Today I'd like to have a bit of a chat with you about what it takes to be in the top 1% of wealthy people. Now, we know that true wealth is much more than how much money you've got in the bank or how many properties you own, but you don't have to look too far to see the references to the top 1% of money earners and how disproportionate the distribution of wealth is, not just in Australia, but around the world. And amongst the many hard truths exposed by COVID-19 is the huge disparity between the world's rich and poor. As economies fell into recession and many ordinary people lost their jobs and fell into poverty, many of the world's billionaires increased their fortune. Each year, Credit Suisse produces a global wealth report showing how money is distributed around the world, and according to their 2020 report, global household wealth has remained unscathed despite the pandemic that swept the world. It revealed that the top 1% of households globally own around 44% of all the personal wealth, while the bottom 50% of all households only own 1% of the wealth. Now, such a divergence in affluence further fueled criticism of those so-called 1%, which has long been standard rhetoric, particularly of the political left. As far as I can remember, it all started way back in 2011, a decade ago, when Occupy Wall Street protesters called out growing economic equality, proclaiming, "We are the 99%. They demonised that 1% as fat cats who've grown even richer while the middle class has stagnated. But you may be surprised to find the 1% doesn't just comprise super rich. It may include you or people you know. When you hear references to the 1%, you might think of billionaires such as Amazon's Jeff Bezos or Tesla's founder Elon Musk. However, as of October 2020, there were 2,189 billionaires worldwide. That's a minuscule proportion of the 7.8 billion people on the earth. 2,189 of them. So obviously, you don't have to be a billionaire to join this global elite. So how rich do you think you need to be to make it into the 1% club? Well, look in the mirror, because it's very likely if you're listening to this podcast, you're already in the 1%. Last year, Credit Suisse's Global Wealth Report in October last year showed an individual net worth of Australian $1,295,000. A combined income of investments and personal assets will make you amongst the world's 1% richest people. In other words, you need about $1.3 million to be amongst the world's 1% richest people. As it turns out, there are even significant disparities within the 1%. But that's not surprising. The 1% turns out to have their own 1%. People like Bill Gates, Warren Buffett, Elon Musk, Jeff Bezos. But when you look at mere mortals, the Australian Bureau of Statistics shows that the average Australian household has a net worth of just over $1 million. And Australia's richest 20% of households, about 2 million of them, have an average net worth of $3.2 million. And even if those households comprised 2 income-earning adults, their net worth equally divided would put many Australians in the top 1% of global wealth holders. So, a net worth of 147,000 Australian dollars puts you amongst the world's richest 10%. So let me just say that again. To be in the world's richest 10% of people, you just need $147,000 net wealth. And to be in the richest 1%, you need about $1.3 million net wealth. Interestingly, Australia's got the second highest median wealth in the world. And we've got a very, very low percentage of poor people, haven't we? Now, prior to the global pandemic of 2020, the wealth of the average Australian household surged past that $1 million mark, as I mentioned. And while it wasn't materially changed by the short, sharp recession Australia experienced last year, the gap between the rich and average Australian, that did widen, with low-income families not seeing any increase in their net worth. And in fact, they haven't seen it for more than a decade. And in Australia, a lot of that has to do with property. Now, clearly, there's a wide gap between the top 1% and the average Australian. And the fact is, Australia's richest households are expanding their wealth 3 times faster than the poorest groups. And many of them are using property to leverage their wealth. Fact is, Australia's wealth is heavily skewed towards property ownership. It's the investment vehicle of more Australians than any other. It's what Australians use to develop their wealth. Simply owning their own home over a period of 10 years or so has made more money for many Australians than just what they do on their day-to-day work. Over this last decade, the value of a lot of homes in Australia doubled in value, which meant that many homeowners saw their household wealth increase substantially. But another group discovered how to profit in ways more than just owning their own home. They became real estate investors. They bought additional properties. They took their financial future into their own hands. Now, that's why I regularly discuss how to become successful in property, how to become a successful property investor, because I want you to become more financially fluent. I want you to be in that 1% of Australians' wealth. But what's the solution to this wealth inequality, you may be asking? Sure, much attention and many headlines are devoted to the unethical wealth of these billionaires. But I believe rather than attacking the ultra-rich, we should focus less on taking action that could inhibit the top earners, and we'd be better off addressing the reasons that other Australians just aren't as successful, and we should be concentrating our attention on how to improve the lives of those in the bottom 50%. In this group, many workers are in desperate need of a skills upgrade. Others need to learn financial fluency. Many need to know how to handle money, so they've got to learn how to delay gratification, spend less than they earn, save and invest in their future. Hey, that's a common theme of this podcast, isn't it? And one great lesson for them is they're either going to have an easy life now and a hard life later, or start doing the hard things now so they can have an easier life later. Just to make things clear, before I receive a flood of negative comments, this isn't a podcast to belittle the hardship many ordinary Australians have endured over the long term, not just during COVID. Needless to say, I can understand why people would be upset when many of the top 1% are perceived to be earning their income unjustifiably, being paid by big corporations that in some cases have been run into the ground and then being bailed out by the government. That just doesn't seem right. Nor does the tax system where the wealth seem to avoid tax and the poor seem to pay a disproportionate amount. You can't argue with that logic. That's hard to argue with. But what I'm offering in this chat with you is another perspective, and reminding you that even though our system has lots of faults, it has actually created more prosperity, even for the lowest 1%, than most of the world can comprehend, considering it wasn't that long ago that I remember reading from the United Nations, nearly half the world's population, 2.8 billion people, earn less than $2 a day. And I remember reading, it was a while ago, though, but from the World Bank, they suggested that 95% of those living in the developed world earn less than $10 a day. So, yes, we have a wide disparity in Australia, but in Australia, there's the opportunity, the potential to grow significant wealth, to become financially fluent, to get a job, to upskill, to learn how to improve yourself. This podcast and my daily blogs are just part of that, but there's so much great information out there. Sure, there are challenges, but we live in the best country in the world and the best time in history, so let's take advantage of it and let's help more and more people become financially independent rather than pulling down the wealthy people. Bring the rest of the people up to their level. In a moment, I'm going to have my chat with John Lindeman, where we're going to talk about the difference between a property boom and a property bubble, and what's ahead for our property markets, what you need to be careful of, and what's going to eventually slow down our surging property markets. But before I do, I want to give you an opportunity of taking advantage of these property markets by spending some time with me and allowing me to be part of your team and your personal mentor in 5 powerful days at Wealth Retreat 2021 that we're holding on the Gold Coast this year on June 12th to 16th. We've been running Wealth Retreat on the Gold Coast for 16 years and we missed out last year because of COVID. But yes, we've booked the room. We're going to be there, and there's going to be Ken Race, Dr. Andrew Wilson, Simon Kirstenmacher, Andrew Myrams, Mark Creedon, and a host of property, tax and finance experts. And we're going to be in a small group environment, so we're going to help you plan the next 5 years of your life. Wealth Retreat isn't a property seminar. It's actually about you. It's my exclusive retreat, and it's perfect for anyone who wants to accomplish something bigger in their life, who feels they've hit a plateau, they had some stumblings in 2020, and want to make some big shifts necessary to get to the next level. So if this sounds like you, whether it's in your property investment or in your business or your entrepreneurial endeavors, I'd love to help you make your dreams come true. You're going to get my personal insights, my personal feedback on your plans, and receive elite mentorship that's going to take your life from great to truly outstanding. So no excuses. This is the year to do it. This is the beginning of a new business cycle, property cycle, economic cycle. So if you want to join us, you're going to get mentorship, masterminding, networking, and you'll have some fun as well as we spend 5 days together on the Gold Coast. Go to wealthretreat.com.au. You can't just book in. Anyone who wants to go has a one-on-one chat with me, so I make sure it's right for you and that you're right for the Wealth Retreat community. There'll be a link in the show notes, but just go to wealthretreat.com.au, spend 5 days with us on the Gold Coast. Hey, it's over a long weekend, so you're not even going to miss that much work. And let's plan the next 5 years of your life. The best is yet to come. We're in a new property cycle, but rather than starting off slowly, as has happened in previous cycles, almost every property market around Australia is exhibiting strong capital growth. This time around, it's actually different to other cycles that I've experienced before, where capital growth starts slowly and in different segments of the market and in different states behaving differently. Currently, almost every market in the capital cities and in regional Australia growing well. At the high end segment of the market, at the first home level of the market, there's one segment that's languishing, and that's the CBD high-rise apartment market. Now, some commentators are claiming that our property markets are heading for a boom. I think they're a bit late to call it. I think we're already in boom conditions. Others are warning we're going to have a price bubble and it's going to bust. Yeah, they're out there already. So what's the difference between a property boom and a bubble? Which of those are we in? What's ahead? They're the questions I'm going to ask leading property researcher John Lindeman of Property Power Partners. John's one of the popular regular guests on this podcast. He's a regular blogger on Property Update and on Your Investment Property magazine. Welcome, John.
Thank you very much, Michael, and hello, everyone. It's great to be back again.
Now, John, let's start with some basics. What's the difference between a property boom and a bubble?
Well, they look very similar when they start because you find that listings start to drop dramatically, demand increases, and of course, prices start to go up. But I think the main difference is in the type of people causing the demand. If it's investors, then there's a chance you could get a bubble. But if it's owner-occupiers, it's a boom which tends to slow down as unaffordability makes its effect And then, of course, prices will slow down, but it won't burst like a bubble.
Well, if you think about it, our property markets are basically driven by owner-occupiers. As you say, 70% or so of properties are owned by homeowners, ordinary Australians. Some have got a large mortgage, some have got no mortgage. And it's just the fact that they can afford more, their wages are more, we've got different lifestyles, we're wanting bigger homes, that property values are going up. But as the cycle moves on, near the end, we've both seen it, John, we've been around, that's when the investors come in, that's when they speculate, that's when fear and greed come in normally, and that's what pushes up the last bit of the cycle into from the upturn stage to the boom stage, and sometimes it overshoots. But in my mind, John, we actually don't see bubbles in the big capital cities that have got a big market depth. They're more likely in certain segments of the market, aren't they?
Well, they are, and in particular unit markets, because most investors buy units. So, 60%, 70% of our units are investor owned. But also you find that regional areas such as mining towns, you might find during the mining boom, 60 to 70% of properties were owned by investors. So that's where you get these bubbles occurring. But we did have nearly a bubble, and that was in Sydney and Melbourne, 2014 to 2017. We had quite significant price rises, and most of the buyers there were actually investors. So that was when APRA stepped in and stopped that occurring.
Well, for those who don't remember, there was a combination of local investors and overseas investors, and that was one of the things that led to the very significant building boom that we saw, high-rise towers littering our capital cities. And yeah, that's unsustainable, John, when 50% of all property transactions are investors. Who's going to rent all the properties? Somebody's got to live in them.
That's right. It's very much a speculative type of investment. People are buying properties on the expectation that prices will go up, and they're not actually looking at the underlying rent demand that must support any property market.
Sure. So, John, this time round, investors are taking a back seat. It's really first homeowners and established owners moving up that are driving the market.
Very much so, Michael. It's because interest rates are at their lowest rates ever. And of course, the governments are providing lots of incentives. But there's something else which is going on, which is the buffer that finance providers insist on. So they say, well, if interest rates at 2%, you've got to be able to afford a 4% rate. Now, the Reserve Bank has said they're not going to increase rates for the next 3 years. And that means, of course, that the banks are saying, well, we can reduce this buffer down because interest rates aren't going to go up. So if we reduce it by 1%, that's in effect like a 1% drop in interest rates. So massive numbers of first home buyers are coming into the market. Lots of people are upgrading because they've got more equity and more borrowing capacity. So that's one of the reasons why, Michael, it's occurring all around Australia. That's usually a sign that it's owner-occupiers that are leading the charge.
I like the word upgrading that you said, because I actually see this as a particular upgrading cycle. It's already happening. Tenants who are unhappy with their accommodation, they've got a whole range of choices with rentals dropping. They're upgrading to better tenancies. I've noticed that a lot of people who were tenants, now they've got a bit of money behind them. They've got stamp duty grants. They've got incentives from the government home builder. They're taking advantage and they're upgrading to become first home buyers. Established home buyers, they can see property prices surging. Many are looking to upgrade their homes to bigger or better accommodation. Homeowners are also upgrading to lifestyle, John, aren't they? We're actually noticing people moving to regional Australia or towns just outside the big smoke. And baby boomers are upgrading their lifestyle. In some ways, I see some downgrading to family-friendly apartments, not the little apartments, but bigger ones, or townhouses, but they're doing it for desirable neighbourhoods, John.
They are indeed. And this is a trend that will continue until the new unaffordability limits are reached. People go to the bank and the bank says, sorry, you're not getting any more money. And that's really the difference between a boom and a bubble, because with booms, it'll slow down. And as the unaffordability limits are reached, buyer demand will slow and the whole thing will just simply, grind to a halt. But it won't be a bubble because these people are living in the homes that they've bought, and they'll only sell if they really have to for personal, family or business reasons.
I think we've learned that before looking through the pandemic we had, that home owners aren't going to give up their home. They've got to go somewhere. They've got to live somewhere. So let's look at what could slow this down. And I think one of the things you mentioned is affordability. And I agree with you. I think another one, if there was something terrible happening with the vaccine rollout not working properly, or with COVID somehow or other getting away again, there's also been talk about regulatory intervention. People are already saying, oh, APRA's going to come in, the Reserve Bank's going to raise interest rates. What are your thoughts on that?
Well, the Reserve Bank has said categorically they're not going to do that. And there's, I think, also great pressure from the government, because it's just lent itself billions of dollars, which it's going to have to repay the interest on. So the government will be very keen to see interest rates stay very low for a long period of time. But also, APRA itself gave a number of benchmarks, said it's only when the percentage of investors goes above, well, I think it was 30%, that they would start to consider new restrictions. And at the moment, the percentage of investors buying properties is much, much lower than that. I think it's only just about 22, 23%.
Yeah, in the low 20s, you're right. So I agree with you. I think affordability is going to be the issue. And we're now moving to a period where wages growth is going to be a bit lower. It ticked up a little bit in the last figures, the December quarter figures. But overall, we're heading for a period of lower wages growth until unemployment goes down sufficiently that it'll push wages up again. So on that basis, the factors that led to this little boom that we're experiencing now, the lower interest rates making finance cheaper, and we did have some rising wages increasing the ability to service debts, they're going to slowly peter out moving forward, John.
They are. And I think what we're looking for then is, well, what will be the next game changer? And I think that will be when our international borders are reopened. I can see a massive number of people wanting to come to Australia to live. And that's because, we've done very well in terms of the devastation it's caused in other countries. And also we've got it through it pretty well economically. So I can see a huge uplift in population in coming years. And that's really good for property investors as well.
Well, it's good for the economy. And so we know that both sides of government have committed. They've got a business plan to grow our population much bigger. It's going to slow down a bit, and we may not get to 30 million by 2030. It may only be 29 million, but there's still another 3.5 million people who aren't in the property market yet. So get in the line before they do.
Exactly.
You get to own the property. And I think another trend that it'll be interesting to see how it goes. I mean, there recently is the regional market trend. What's going to happen there? I see that recently property prices in regional Australia have grown probably double the rate of capital cities. Now, in part, it's due to the newfound popularity of regional options. I think it's probably likely to lose a little bit of steam as we end up into a more post-COVID environment.
I agree with you entirely. I think it's something that is a bit of a flash in the pan, really. I think that most people, although they might be temporarily attracted to regional areas, they'll realise that, hang on, my family, my friends, my employment, when occasionally I do have to go into the office, all of these are located in the big centres, and that's why people will still want to live in capital cities much more than regional areas.
Well, I know I'm reading that people are moving to regional Australia, but I went to a couple of open for inspections last weekend. I attended a couple of auctions. You just have to see how many people are still wanting to buy in all our capital cities at the moment that you realise that the bulk of buyers, sure, there's a trend of a few people moving to regional Australia, but the bulk of buyers still want to live in the big smoke. But they're now being fussy. That always happens at this stage of the cycle, a bit of a flight to quality.
That's right. And there's plenty of options available. We're looking at new types of housing that's much more sort of environmentally friendly, and also new areas that, when you look at some of the new developments, and they take much more interest in lifestyle and putting in bike paths and things like that. So I think that we'll still continue to live in the big cities.
Yes, but we may live in slightly bigger accommodation. We're going to be careful in the neighbourhood that we live in because we want the ability to I don't know, ride, drive, walk within 20 minutes of having all those facilities. So the importance of the right neighbourhood and lifestyles become important. So, John, I guess the bottom line is we're at the early stage of a new property cycle, and currently the mix of increasing consumer confidence, pent-up demand, historically low interest rates, easy finance, all the government incentives, that's causing a surge in particularly owner-occupier demand. But I think we both agree when the new affordability ceilings are reached, growth's going to slow down, but it's not going to burst. We're not in a bubble. Is that right?
Very much so, and that's proven by the fact that the investors only, generate about 22% of housing finance loans. It's being led by owner-occupiers, people who live in their homes, who will want to stay in their homes. When things start to change a little bit and the growth stops, then people simply stay in their homes. They don't sell. Whereas investors, when things start to turn a bit bad or negative, whatever, they quickly try to sell their properties because they can. So there's a fundamental difference between investors and owner-occupiers, and owner-occupiers are the ones who provide that long-term security to the market that investors look for.
Sure. And I guess then to just extrapolate what you said, it's the investors that create the swings, the big ups, because we know that it always overshoots a bit, and then the big downs as well. But the property market's nowhere near as volatile as the share market, so I'm still comfortable holding well-located property. Thanks for your time again, John. Now, if people want to find out more about you, because you actually got some good reports that I know I enjoy getting your insights, where do they find out about you?
If they'd like more information, all our blogs and reports are available on lindemanreports.com.au. That's our website. And it's got lots of interesting information and also information about the reports that we provide on where the best opportunities are for cash flow and growth.
Well, what I'll do is, of course, leave a link in the show notes so people don't have to remember that. But John Lindeman from Lindeman Reports, thanks a lot. Look forward to catching up again real soon.
It's been a pleasure. Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you a question. Whose investment are you? The fact is, most people work for someone or an organisation. From the perspective of the employer, their employees represent an investment, an asset. From the perspective of an employee, their employer is a means to an end. And that end, for most unfortunately, is just that payday, the paycheck. However, a select few, they're in it for more than a paycheck. They go the extra mile. They do more than their job description. They pursue responsibilities that go beyond their job description. And here's a little known secret to success that only a small number of employees have ever discovered. Going that extra mile is an investment in themselves. You know, when you do more than your job requires, you grow. As you grow, you become more valuable, not just to your employer, but to every competitor in your industry. The more you go beyond just earning a paycheck, the more you learn, the more new people you come in contact with, the more the value of your own stock rises. Going beyond a paycheck and your job description shifts the investment from your employer to you. It's an investment in yourself. And the more you invest in yourself, the more opportunities you create. And that's one of the hallmarks of self-made millionaires. If you want to become successful in life, you must invest in yourself. You've heard the late Jim Rohn say it so often, work harder on yourself than you do on your job. You must take the responsibility that pushes you outside your comfort zone. This discomfort, it means you're growing. So when you go above and beyond your job description, you're no longer an investment of your employer, you become your own investment. Well, we covered a lot today, and if you got some benefit from today's show, I'd love you to do me a favour and tell somebody else about it. I'd like you to help me in my quest to make as many people as financially successful as possible. So if they learn how to become part of the 1%, if they understand if we're going to have a property boom or a bubble, wouldn't it be great to help them take advantage of the new property cycle that's occurring? So use the share button on the podcast app or tell somebody about it or tell the world about it by leaving a review. And if you do, and I read it out as I'm about to at the moment for bhutch@gmail.com, I'm going to say thank you by gifting you one of my books. So just email me, michael@metropole.com.au, when I read out your review. And Bhutch said, must listen every week. Michael and the team provide perfect combination of information and inspiration in this property investment podcast. I'm a listener to multiple investment podcasts, and the content is always straightforward, effective and relevant, a testament to what is obviously a wealth of knowledge he's gained through the years of experience. Highly recommended. Gee, thank you for that lovely 5-star review. In fact, I get lots of 5-star reviews, and I'm pleased about those. So look forward to hearing from you and saying thank you with a gift of one of my books. Now, I'll be back real soon, twice a week, but in between these podcasts, you can catch me on social media. Just look for me at Michael Yardney, or why not get something each day exclusive, things that I don't put elsewhere, through our private Facebook group. Just look for the Property Update private Facebook group. Just go to Facebook and look for Property Update, and I'd like to have you as part of my community. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?